Welcome to the online classroom for the module FIN4801, Advanced Financial Management. This is class number 1 in the course, and it's the sister module to FIN3701, part of the UNISA financial management courses. The module is based on the prescribed textbook by Carlos Correa, and basically advanced financial management goes through the first 17 chapters of the prescribed textbook. So if you understand the first 17 chapters of the prescribed textbook and the questions at the end of the textbook and all the important concepts I'll be taking you through, you should be fine with the module. So in this first class, I'm going to take you through an overview of financial management. A lot of the things I'm going to discuss in this chapter are things that you're most likely going to be familiar with from your previous studies in financial management or even strategic management or other modules closely related to financial management. Some of the concepts are covered in FIN2601, like defining what financial management is, defining the role of the financial manager, describing the various forms of business organization. These are things you will have most likely covered in your other financial management modules. It's not talked about in FIN 3701, but it's talked about in FIN 2601. So I'm just going to take you through some of the important concepts you need to know. Like I said before, a lot of them you'll be very familiar with. From strategic management, you might be familiar with Porter's 5 forces, SWOT, and PEST analysis. You might also be familiar with good corporate governance and the King 3 report from risk management and also strategic management. So the first thing you need to note in study unit 1, so study unit 1 is an overview of financial management. And the first thing you need to note is that financial management is a management function. It's one of the many management functions that an organization will have. Remember, there are different types of management functions that an organization can have. There's the human resources function, there might be the IT function, there might be the risk management function, there might be the operations function, purchasing function. So a company is made up of many different functions. And then one of the most important functions in a company with regards to management is financial management. And the reason why financial management is a very important function is because financial management controls the money in the company. So if you work in the financial department of any company, you work for a very important function, because for anything to happen within an organization, money is required. And that means that the financial management function has a very important part to play in any organization. They get to see where money is going and what it's being used for. That's why you find that a lot of financial managers or a lot of chartered accountants end up um, as the directors of companies and so forth, because the finance function of a company is very important. Because if you're in the finance function, you get to dictate where money goes, and you get to see what exactly is happening in the company strategically in the long term. Okay, so the financial management function involves the process of planning, organizing, controlling, and monitoring financial resources with a view to achieve the organization's goals and objectives. So remember, the main objective of any company, including the financial management function, is to maximize the value of the firm. And remember, the value of the firm is measured through the share price of the firm. Okay. So the key goal of any company and the financial management function is to maximize the value of the firm, which is measured through the share price. So traditionally, textbooks will just say the main objective of financial management is to maximize the value of the firm measured by the share price. But with corporate governance, you also need to make sure that you're trying to maximize the value of the firm measured by the share price, whilst also taking into account the needs of different stakeholders. So, as a company, and as the financial management function, not only should you be concerned with maximizing the value of the firm as measured by the share price, but you need to do that whilst also taking into account the needs of the different stakeholders. And remember, a company has different stakeholders. Some examples of stakeholders are employees, customers, suppliers, the government, competitors. Those are all stakeholders. So the management of the company just shouldn't aim to increase the share price only. They need to consider how they can increase the share price whilst also considering the employees, also considering business ethics, also considering their customers. So it's not just a case of maximizing the value of the company. That needs to be done by also considering the different stakeholders, most importantly, the shareholders and the employees and the customers. So, financial management is also closely related to a number of disciplines. You also need to know that to be a good financial manager, you also need to have a good and solid grasp of economics and also accounting, because as a financial manager or a financial person in any financial function in a company, you need to be able to interpret economic indicators like inflation rates, um, GDPs, exchange rates, and so forth, and how they can affect your company and your financial plans. And you also need to be able to interpret financial statements, how financial statements prepared, calculating financial ratios, so that you can properly make financial decisions. So, a financial manager should also have a good understanding of economics and also accounting. And then you need to also know the two key decisions that the financial manager has to make. This is some revision from FIN4601 and earlier modules. Any financial manager is faced with two key decisions. Some prescribed textbooks actually say three key decisions, but Korea says two. There's the investment decision, which is a decision on where to spend your money as a company. And then there's the financing decision, which is the decision as to where to raise the money. Okay. Investment decisions, where should we spend money? Financing decisions, that money we need to spend, where should we raise it? Okay. So some textbooks also say that the financial manager has a third key decision, which is the dividend decision, how much dividends to pay and how to pay those dividends. But for the purposes of Korea, we are told that financial manager has two key decisions, the investment decisions and the financing decisions. So there's a diagram here that just summarizes some of those decisions. Like I said, investment decisions are about where to spend money. So when a company has, so remember, a company will want to spend money to try to generate a return for shareholders. And the company can either invest in operating assets or in financial assets. Now, operating assets are things like printing machines, buildings, inventory. Inventory would be a current operating asset. A building and a machine would be a non-current operating asset. or some machinery to try to increase returns. Those would be non-current operating assets, whereas things like inventory would be current operating assets. So the financial manager has to decide how much non-current assets and which non-current assets to invest in and which current assets to also invest in. Okay. And then likewise, the financial manager also has to decide which financial assets to invest in. Now, financial assets are investments. When a company has money, a company might decide to invest that money in money market instruments, right? That's a form of investment like treasury bills or commercial paper. The company might decide to invest their money in shares. They might decide to buy shares in other companies. That's a financial assets. Or to loan out money to other companies in the form of bonds. So those are financial assets. So the financial manager has to help top management in making investment decisions, the best investment decisions. And then the financial manager, to remember to invest, you need money, and then the money has to come from financing opportunities. So the financial manager also has to explore financing opportunities. So that means the financial manager has to explore where to raise money from. So the financial manager can raise money through equity or through debt. The company can raise money through equity, which is shares, or through debt, which is loans. And the company can also raise money through money market instruments. So just so the financial assets the financial manager can invest in can also be sources of capital when the company is raising money. Remember, we said the company can invest in financial assets such as equity, debt, and even money market instruments. Likewise, when the company wants to raise money, they can raise money in capital markets through equity and debt, and also through money market instruments. So this can also be illustrated in the statement of financial position of the company. The parts to do with the non-current assets and current assets of the company, that has to do with the investment decisions, where the top half has to do with investments in non-current assets, the bottom half investments in current assets and also financial assets. And then the last part of the statement of financial position has to do with the financing decisions. This is where the company has to decide where to borrow money from. So we can look at the financing and investment decisions that the financial manager has to make in the context of a balance sheet, in the context of a statement of financial position. Okay. So that's also important. So remember, the top half of the statement of financial position has to do with the investment decisions. The bottom half has to do with financing decisions. So when a company decides how much borrowings to have, how much equity to have, how much current liabilities to have, they are making a financing decision. And when they decide which property, plant, and equipment to have and how much, which inventories to have, finance lease receivables, they're making investment decisions. And then chapter one, importantly, as a background on financial management, as a background on an overview of financial management, you also need to know the forms of business organization and the forms of ownership. These you should be familiar with from previous studies. So forms of business organizations, according to Correira, we can classify businesses according to their activities. We can have businesses involved in extractive activities such as mining and agriculture. So a business would be described as an extractive business, or a business in extractive activities if it's into mining and agriculture. Some businesses are in manufacturing activities, such as the production of goods using raw materials. Others are in merchandising activities, such as wholesalers and retailers, and then service activities, such as financial services. These would be banks, insurance companies, and so forth. So you can classify businesses according to the activities they do, but more importantly, you can also classify businesses according to um, the forms of ownership. The forms of ownership. This is what you should be familiar with, and you should also make sure you know for the purposes of FIN4801. Businesses can be classified as sole proprietorships, as partnerships, as private companies, and public companies. So you should be familiar with this. I would advise you to just remember this table. Remember, um, a company, whether private or public, is a separate legal entity, meaning you can sue a company or a public company, but you can't sue the shareholders in a private company or public company. For legal purposes, private companies and public companies are viewed as separate legal entities. Whereas for sole proprietorships and partnerships, these are not considered as separate legal entities. If you enter into a contract with a sole proprietor or a partnership, you can take the owners, actual individuals who are the owners, to court. The liability of the owners is unlimited under a sole proprietorship and partnership because of the form of legal entity. Whereas for a private and public company, the liability of the owners is limited because if you have any issues with the company, you take the company to court. But if you have any issues with a partnership or a sole proprietorship, you take the owners to court. Private companies and public companies have relatively high cost to set up, but for a public company, it's higher than a private company. Whereas proprietorships and partnerships have low cost and they don't have a lot of regulation. Sole proprietorships and partnerships, the government will just tax the owners, whereas with a private company and public company, it's actually the entity that is taxed, and the owners are taxed separately. And then companies find it easier to raise capital, especially public companies, compared to sole proprietorships, partnerships, and private companies. We are also given the tax rates here: 40% for partnerships and sole proprietorships, and 28% for public and private companies. If any shareholder dies or decides to leave a company, a private or public company can continue, but a sole proprietorship or partnership will cease to operate if the owner decides to leave the business, whether on purpose or not. Separation of management and ownership that occurs in a public company, usually not in a private company, and never in a sole proprietorship and a partnership. Secrecy of operating returns. In a public company, operating returns are public, but the financial statements of a partnership, sole proprietorship, or private company are usually private. Disclosure requirements: because the financial statements are private, it means that partnerships and sole proprietorships and private companies have very low disclosure requirements, but public companies are required to publish their information publicly. Okay. Audit requirements: yes for public companies, no for private companies, no for partnerships, no for sole proprietorships. And then ownership freely transferable, yes for public companies. You can easily buy shares in a public company. That's why public companies need to publish a lot of the information, because individuals in the public can easily purchase and sell shares in a public company. But with sole proprietorships, partnerships, and private companies, it's not easy to transfer the ownership. You actually have to negotiate with the owners and make private arrangements. So you need to know these. These are things you should be familiar with. So a lot of it is revision. And then something really important with regards to financial management is what we call the agency issue. Remember, in any company, especially public companies, we are now looking at mainly at public companies, the agency issue is a big problem in public companies, not in sole proprietorships, not in partnerships, not in private companies. The individuals who own the company in a sole proprietorship, or in a close cooperation, um, in a sole proprietorship, or in a partnership, or in a private company, the individuals who own the company are also the managers. So there's no agency issue. The agency issue arises if there's a separation, of the management and the ownership. So the separation of management and ownership, that means if you have different people managing the company and different people owning the company, um, it leads to what we call the agency relationship. That means that the owners of the company, who are the shareholders, and the management of the company have what we call an agency relationship. So, in an agency relationship, the managers act as agents. The managers act as representatives or agents on behalf of shareholders. But there's always the risk that the managers might decide to put their own interests first. Okay, so that's the agency problem. So management are agents of the shareholders, and they should act to maximize the value of shareholders' wealth. But there's a real possibility and a chance that the shareholders and the owners will experience losses because managers might take decisions that are in the best interest of managers rather than the best interest of the shareholders. So that's an agency problem. A manager is an agent acting on behalf of the shareholders, but you might find that the manager, as an agent, might decide to act in their own best interest. And when a manager decides to do that, we call that an agency problem or an agency issue. So shareholders usually have some mechanisms that they can put in place to try to prevent the agency problem. So, how do shareholders ensure a closer alignment of the objectives of shareholders and management? How can shareholders make sure that management won't act to further their own interests as management rather than the interest of the shareholders? Okay. So, in order to avoid conflicts of interest and ensure that management do not follow their own objectives, shareholders will incur what we call monitoring costs. Shareholders will have to actually spend some money in trying to monitor um, the management of a company. So these monitoring costs, these are like expenses that the shareholders will incur, which are sort of like controls and incentives to encourage management to take decisions that will maximize shareholders' wealth. So these expenses or these costs that the shareholders will incur are known as agency costs. So what types of controls can the shareholders implement such that management act in the interest of shareholders, or what are the reasons that management might actually act in the interest of shareholders? So the types of controls that shareholders could implement are compensation plans and share options. So basically, with compensation plans and share options, the shareholders will say to management, if the share price goes up adequately, we will make sure that you are compensated adequately. As in other words, the financial payments or the bonuses of management will be tied to the share price. So that will incentivize managers to act in the best interest of shareholders. Or management might also be given share options where they have an option to actually buy the shares in the company. And then this might push management to try to act in the best interest of shareholders, knowing that they also have an interest in the share price going up. So that would prevent the managers of the company acting in their own interest, but rather considering the interest of shareholders. A second control measure is the threat of takeover, or it's a reason. So management might know that if they perform badly with regards to the share price and the profitability of the company, and if they act in their own interest, there might be a threat of takeover from other companies, and that might result in a change in management. So to try to prevent that, managers might end up acting in the best interest of shareholders and not acting in their best interest. So that can also help to control the agency problem. So it's a real big problem that a lot of companies will try to make sure that management act in the best interest of shareholders by making sure they have compensation plans, share options, and also managers by themselves might also have the fear of takeovers. So that might also push them to act in the best interest of the company and the shareholders reflected by the share price. And then the agency problem just doesn't apply um, between managers and shareholders. The agency problem can also exist between shareholders and bondholders. Okay, so please note, a lot of you might be familiar with the agency problem as it occurs between shareholders and management. But there's also another agency problem between existing shareholders and bondholders. Remember, bondholders are lenders to the company, whereas the shareholders are the actual owners of the company. So when banks lend funds to a company or when investors purchase a company's bonds, they do so on the basis of the risk of existing assets, right? So you might find that the management of a company, once they've borrowed money from a bank, they might actually start acting in a way to benefit shareholders rather than the lenders, rather than the people who lent money to the company. Okay. So that can also create an agency problem for bondholders, right? So you might find that management might start acting in a way to benefit shareholders at the expense of another important stakeholder who is the bondholder. For example, you might find that management might continue to issue more debt, which will reduce the value of existing debt to the detriment of bondholders, to the detriment of lenders. And you might find that management decides to increase dividends, which might mean that debt holders, lenders have less security. And you might find that management might start to increase the risk of assets as the full benefits will flow to the shareholders, whilst exposing the debt holders, the lenders, to a lot of risk. So these are agency problems that can also exist between the management and the bondholders. Okay. And that might result by management trying to benefit the shareholders at the expense of the bondholders. Remember what I told you at the beginning? I said that as much as a company might want to maximize shareholder wealth, they also have to consider other stakeholders in their attempt to maximize shareholder wealth. So that's important. So you might find that the agency problem, as much as the management might try to benefit the shareholders when they've borrowed money by increasing dividends, investing in risky investments, they might be doing so at the expense of existing bondholders, at the expense of lenders, and that's a problem. So if companies continue to do that, capital markets don't forget, it might mean that in the future, when the company wants to raise more money, the cost of raising that money will rise significantly. And it might also mean in the future, when the company wants to raise money, they might get money with loan covenants where they have a lot of restrictions on what they can do and what they can't do, so that bondholders are protected against management just trying to act for the benefit of shareholders. So that's important. So to actually help other stakeholders, and to actually make sure that in a company, management just doesn't look out for itself and they just don't look out for their shareholders. Um, in South Africa, there's what we call the King 3 um, corporate governance framework. There's actually what we call the King 3 corporate governance framework. And the idea behind the King 3 corporate governance framework, or behind good corporate governance, is that when a company makes decisions, a company shouldn't just make decisions based on management itself and the shareholders. The company also needs to make decisions taking into account all the different stakeholders. And uh, good corporate governance or corporate governance provides uh, a framework or certain principles that a company should adhere to, such that when the company is making decisions, okay, so corporate governance is like a framework that a company should adhere to when making decisions. And the idea behind the principles or the guidelines is that the company should just not consider its own interests. Rather, the company should consider the interests of all stakeholders. When the company is making decisions, the decisions should be holistic in nature, considering all the key stakeholders as they aim to maximize the value of the company. So in South Africa, there's a report and a framework that was created. It started as King 1, King 2, and right now we're at King 3. And it's just a set of guidelines and a set of principles by which companies in South Africa are obliged to follow, such that the idea to get to good corporate governance. Okay. So King 3, the King 3 report, which has the corporate governance framework that companies in South Africa are encouraged to follow, I don't think it's actually a legal requirement to follow the King 3 code framework, but these are policies and procedures and principles that if a company wants to attract money through shareholders, if they want to operate with a good reputation in the market, the company should adhere to these principles. So King 3 states that strategy, risk, performance, and sustainability are inseparable, and there are certain major requirements of King 3. So I'll just briefly explain some key concepts here with regards to the King 3 framework. Yeah, the key principles of King 3 relate to effective leadership, sustainability. Sustainability just means that when a company is operating, they shouldn't just look at what they are doing today, but rather they should look at their actions into the foreseeable future. If they are if they are building factories in a certain area, are their operations sustainable for that area? Are they thinking about the future with regards to the resources they are using? It ties into climate change and global warming and all these other factors. Corporate citizenship ties into ethical practices, good social responsibility, and good governance, and so forth. So the board of directors should set ethical values of the firm and define corporate strategy. And then sustainability is defined as the primary moral and economic imperative of the current century. Corporate citizenship requires that the company should operate in a sustainable manner, and sustainability is embedded in the South African Constitution. So, what are the major requirements of King 3? So, what are the key principles that King 3 says that a company should adhere to in the context of corporate governance? Well, one of the major requirements is that when a company appoints a board of directors, remember the board of directors manage the company on behalf of the shareholders. And then the board of directors appoints managers who run the company on a day to day basis. So, one of the major requirements of King 3, a lot of countries also have their own corporate governance frameworks, and they are very familiar or similar to King 3. First of all, a company should have a board of directors with executive and non-executive directors. Okay, so with any company, the people who are running the company on behalf of the shareholders, who are the board of directors, who then appoint the managers who run the company on a day-to-day basis. This board of directors consists of what we call executive directors and non-executive directors. Executive directors are usually the ones who really know the company. Some of them have a deep understanding of the company, and they are involved and help the management with the day-to-day running of the company. But there are also what we call non-executive directors or independent directors. These are usually directors who don't have any background with the company, as in they are appointed externally and independently, and they just act as a balancing force on the executive directors. They come into the board of directors with an impartial view, just to question some of the decisions the executive directors might be making, to keep them accountable. Okay, so these are usually people who don't have any ties to the company, who come through as independent directors. In some countries, they are called independent directors, in others, non executive directors. So, what they do, they just come and sit with the board of directors, with the executive board of directors, with the executive directors, and they question and provide impartiality when it comes to decisions. Again, to try to manage the agency problem and to also make sure good corporate governance is being executed by the executive directors. And then the non-executive directors might also be responsible for the audit committee when financial statements are produced, to vet those financial statements just to see if they're being produced properly. They also help come up with the salaries for the executive directors or their remuneration, and they question if those salaries are important or not. So non-executive directors are another balance and check on the day-to-day operations of the company and the decisions that the executive directors are making with respect to the company, so that the interest of all stakeholders, including ordinary shareholders, are met. Another major requirement of King 3 is that a company should produce sustainability and integrated reporting. This means that a company shouldn't just report on its financial profits, but rather the company should also report on how it is aiming for sustainability, and sustainability and environmental aspects and social aspects should be combined together with the financial reports to provide integrated reporting. In other words, a company shouldn't just report on its finances, it should also report on its social responsibilities, its ethics, what is it doing for the betterment of society, and how sustainable is the business and the way the company is operating. King 3 also requires a company to manage its risks properly, to have proper risk management committees, and to clearly disclose how it's managing risk, how it's managing its IT systems in the company, how IT is governed, also how solvency and liquidity tests are being carried out to make sure that the company is financially sound, and also any issues to do with business rescue should the company face financial difficulties. So the key thing here with these frameworks on corporate governance and King 3 is that we are trying to emphasize ethics in financial decision making. Ethics are really important. And the idea behind King 3 and corporate governance is that ethics should influence everything a company does. And a company's reputation is often built on ethical values and good corporate governance. If you remember, some time back, I think there was some ethical issues with an auditor in South Africa, and it resulted in that auditor losing a lot of business. If I recall correctly, I think it was KPMG. There were some ethical issues, and the company's reputation was hit really hard by that scandal, and it resulted in a lot of business being lost. So the idea behind King 3 and good corporate governance is that um, you shouldn't just think as ethics as being an extra expense on the company. Rather, if a company pursues good ethics, it means that the company has a good reputation, and a good reputation should also result in good business. So that's important. So King 3 states that the board of directors should ensure that the company's ethics are managed effectively. So this involves ensuring an ethical corporate culture, articulation and adherence to ethical standards, and implementing a code of conduct and ethics related policies. So that's really important. And you'll find if you decide to pursue professional courses, for example, if you decide to pursue ACA for chartered accountants, or CIMA for management accountants, or CFA for chartered financial analysts, or SICA, or any other professional courses, whether a chartered secretary and so forth, they emphasize professional ethics a lot. They are really important. And they also have code of conduct for their members. Because if if a professional institution is seen to be not ethical, they lose credibility. If people view members of the professional association as not being ethical, they lose credibility, and that can affect their reputation, and it can totally affect the profession. So good ethics result in good business for big companies. So it should always be emphasized. And then the last thing you need to note in the first study unit on an overview of financial management is corporate strategy. Corporate strategy is closely related to financial management. So financial management decisions should be aligned with the company's corporate strategy. So corporate strategy involves the company setting out its mission and objectives in context of the business environment that it's working in. In other words, when senior financial management um, is setting its goals, it needs to also consider the corporate strategy of the company, and likewise, when the directors are setting the corporate strategy of the company, they also need to consider the financial management aspect. The two are intertwined. So usually corporate strategy can be devised using a number of models. You might have come across these if you did strategic management. There's Porter's five forces, there's SWOT analysis, which is strength, weaknesses, opportunities, and threats. And there's PEST or STEP analysis, which is political, economical, social, and technological factors that might affect the company. So these are just models that are used to try to identify um, strategic issues surrounding the company and how best the company can set its strategic plans. So the Porter's five forces are the level of rivalry, existence and threat of substitute products, the threat of new entrants, bargaining power of firms' customers, bargaining power of a firm's suppliers. So these were devised by Michael Porter of Harvard. So if you have your business or you're an entrepreneur, these are always important things to look at. Even if you are in a strategic position in a company, you need to consider these things when you're setting your corporate strategy for the short, for the medium to long term. Do you have rivalries? Is there any substitutes to your products, or are there threats of substitutes? Is there a threat of new entrants? What's the bargaining power of the customers, and what's the bargaining power of the suppliers? You also need to do a SWOT analysis before setting your corporate strategy. This involves identifying the strengths, weaknesses, opportunities, and threats in your company. You could just list them down. And you also have to do a PEST or a STEP analysis, which refers to looking at your company or your business and looking at the political, economic, social, and technological factors that might have a material impact on the profitability of your company. So, in the prescribed textbook with regards to corporate strategy, you could read through some examples. There are a number of examples where they just give you some companies and case studies, and then they go through some analysis to do with Porter's five forces, and also to do with the SWOT analysis. You could read up on those if you have spare time just to better understand it. But I think what I've given you should be sufficient. And you could also look at the PEST or step analysis examples. It's important to understand this. PEST analysis can also be extended to PESTEL, where you also include environmental and legal factors, but it's mostly usually just PEST. Okay, so you could also go through that. So thank you very much for listening. That brings us to an end of study unit 1. Which is an overview of financial management, right? It's a really important study unit. A lot of the concepts, or some of them, you might be familiar with from your previous studies, but others you might not be. Okay, others might be new to you. The next study unit is going to be time value of money. A lot of the concepts of time value of money you will be familiar with from your previous studies. Chapter 2, time value of money. So I'm not going to spend too much time here. And what I'm just going to do, I'm just going to ask you to look at some questions. I'm going to ask you to look at some questions and to just go through some of these calculations. You see, these are just some examples. If you look, study unit 2, there's no reason to go through the whole study unit. I really do not think so. Let me just check and see. I don't think there's any reason to go through the complete study unit. What I would advise you to do rather is just to attempt questions 2, 3, 4, 6, 8, these questions in your prescribed textbook. It's a lot of revision. It's just taking your financial calculator, attempting these questions, right? Just as a means of revision. They're just things you'll be familiar with. And then in the next class, I'll also take you through some of these questions, question 1, question 2, question 3, question 4. These are the questions I'm referring to are questions which are found at the back of the prescribed textbook. So in the next video, I'm going to take you through some of these self-study problems, right? I'll take you through question 1 and 2, these questions, just to remind you using a financial calculator how to attempt those self-study problems. We'll be using a financial calculator, not the formulas, so don't worry about the formulas. So I'll take you through some of these questions and just explaining how you attempt them. And then after that, you can then attempt question 2, 3, 4. The questions I'm talking about when I say question 2, 3, 4 are now these questions. Question 2, 3, they're just simple questions, and the calculations are at the back. It's just important to be comfortable with your financial calculator. These are calculations that you will have done a lot of in your undergraduate study. So thank you very much for listening. That brings the class to an end. Any questions or queries on anything covered, please feel free to let me know on the numbers up on the screen. I won't always be able to get back to you promptly, but I'll try to do so as soon as I can. Thank you very much.